A big question for investors managing the complicated 2024 financial markets is where interest rates are going. In times of uncertainty, dividend stocks become a safe haven, with many companies giving strong dividend payouts at attractive prices. In this video, we look at the 15 best dividend stocks for 2024 and give each one a thorough analysis that shows how it is doing now and what it could do in the future. Number 1. JD.com Incorporated. Dividend yield, 2.7%. Even though Chinese markets are unstable, JD.com is still a good place to buy, even though its stock has dropped almost 80% from its high point to its low point since 2021. The way the market feels does not match up with the company's financial health, since JD.com is still growing. Analysts think that earnings were raised by 15% for the whole year of 2023, and they think that this trend will continue into 2024. The difference between earnings and opinion has pushed the price of JD's shares down to just 7 times forward earnings, even though the 2.7% dividend yield makes them look appealing. Number 2. CK Hutchinson Holdings Ltd. Dividend yield, 6.9%. Even though CK Hutchinson Holdings is having trouble because of China's economic problems, it is still a good option because it has a wide range of businesses, including retail, telecommunications, infrastructure, and seaports. The harbor business, which is in charge of 293 berths in 51 ports in 25 countries, is an interesting addition. The price of CKHUI's shares has dropped from a high of over $20 in recent years to where they are now. They have a trailing earnings multiple of 5.5, which means they offer a good 6.9% dividend return. Number 3. On Main Holdings Incorporated. Dividend yield, 8.6%. On Main Holdings has made a name for itself as a specialty consumer finance business by giving personal loans to people with mostly good credit. On Main has a long history that goes back to its time with Citigroup Incorporated. Its strong credit metrics and high earnings put it in a good place in the market. The stock has been going up since late 2023, and it has a forward earnings multiple of about 7. This makes it a good investment, and the 8.6% dividend yield makes it even better. Number 4. Duke Energy Corp. Dividend yield, 4.5%. As the largest power company in the southern United States, Duke Energy Corp. is in a good situation because of the renewed interest in nuclear power. Duke is very important to the region's power grid because it runs 11 nuclear power plants with a total capacity of 10.7 gigawatts. Even though Duke Energy stock prices have recently gone down because of higher interest costs, the company is still a good investment for people who want to get dividends. The company's plans to spend more and have a positive outlook for 2024 make it more appealing. It is a good time to buy because the dividend yield is 4.5%. Number 5. Southern Co. Dividend yield, 4.1%. Southern Co. is a power company that relies a lot on nuclear power. Right now, the economy as a whole is not doing well because of uncertainty about Federal Reserve rate cuts. The company's decision to move away from coal-powered energy and its large investments in modernization and lowering emissions set it up for long-term success. Since stock prices have recently gone down, Southern's dividend yield has gone over 4%, making it a good choice for investors who want to make money. Number 6. Newmont Corp. Dividend yield, 5%. With one of the biggest gold mines in the world, Newmont Corp. had to deal with problems during a slump in the whole industry. The initial excitement about gold miners as inflation hedges subsided, which had an effect on how well Newmont's stock did. Despite this, the company's wide range of precious metals mines and its hope that earnings will rise again next year make it a strong player in an industry that has been historically unstable. At the moment, Newmont's shares have a yield of about 5%, which makes them a very appealing option. Number 7. British American Tobacco plc. Dividend yield, 9.8%. British American Tobacco, a global tobacco giant, went through a big drop in late 2023 after having to pay non-cash costs because its cigarette names lost value. Even though the company said it lost money, investors should note that it is now shifting its focus to less harmful ways to give nicotine, such as vaping. Additionally, BTI's focus on expanding these alternatives, along with its estimated 6.6 times next year's earnings multiple and impressive 9.8% dividend yield, make it a very appealing value purchase. Number 8. Mosaic Co. Dividend yield, 2.8%. Mosaic is a basic materials business that specializes in agricultural inputs like potash and phosphate. Agricultural prices went up, which helped the company make a lot of money. But problems arose in the sector in 2023, which caused Mosaic's shares to drop. Even though the economy is bad right now, Mosaic is a good long-term investment because it has a strong balance sheet and expects to recover quickly when the agricultural sector starts to grow again. Additionally, phosphate's use as an ingredient in electric car batteries adds a growth aspect to Mosaic's potential. Number 9. APA Corp. Dividend yield, 3.4%. Apache used to be the name of APA Corp., which works in the oil and gas industry and has different projects in the US, Egypt, the North Sea, and off the coast of Suriname. Egypt's political unrest and unsure economy have had an effect on APA's stock prices, which have been made worse by problems in the industry as a whole. But APA's investments in promising projects, such as offshore Suriname, put it in a position to make money in the future. Even though the stock is having a bad day right now, its long-term chances and 3.4% dividend yield make it more appealing. Number 10. Toronto Dominion Bank. Dividend yield, 5.2%. The Toronto Dominion Bank, which people often just call TD Bank, is one of the biggest banks in Canada. Even though Canada's banks are generally losing money, investors are still confident in TD's future because of its size, good track record, and large stake in the brokerage firm Charles Schwab. TD's stock is near its 52-week lows because of worries about Canada's economy slowing down. However, it has a good 5.2% dividend yield, which could make it a good investment for people who want to make money. Number 11. Air Products and Chemicals Incorporated. Dividend yield, 3.2%. Air Products and Chemicals is an important company in many fields because it deals with industry gases, chemicals, and technologies that go with them. To name a few of its many uses, these are medical gases and green energy projects. APD is getting ready for the growing market for sustainable energy by putting $30 billion into projects in green hydrogen and carbon capture over the next few years. Even though the company's stock dropped after reporting results, its long-term appeal comes from its growth prospects and 3.2% dividend yield. Number 12. Gilead Sciences Incorporated. Dividend yield, 4.2%. Biopharmaceutical company Gilead Sciences has had problems in recent years because sales of its hepatitis C virus products have gone down. The stock has gone down sharply as the company tries to come up with another big launch. Even though Gilead's stock dropped after a disappointing earnings report for the fourth quarter, the company's plans to increase its dividend and expand its product line make it a more appealing option. The stock is worth buying because it has a 4.2% dividend yield, which is an income component. Number 13. Verizon Communications Incorporated. Dividend yield, 6.6%. Verizon Communications, a big name in telecommunications, has dealt with the difficulties of rolling out 5G and the stresses of competition. Many of Verizon's 5G investments are now complete, and the recent problems faced by its rivals, the cable companies, make the company look good. Verizon has had mixed earnings results, but its 6.6% dividend yield and the possibility of lowering its capital spending in 2024 make it a good choice for investors who want to make money. Number 14. National Storage Affiliates Trust. Dividend yield, 6.2%. Even though National Storage Affiliates Trust is a fairly new self-storage REIT, it has grown very quickly since it started. Even though interest rates have caused stock prices to drop sharply, NSA's big dividend payout of over 6% makes it a good choice for investors who want to make money. The company's focus on the self-storage market and lack of exposure to the problems in the housing market make it strong in the real estate investment trust environment. Number 15. Realty Income Corp. Dividend yield, 6%. Realty Income Corp is a triple net REIT that has been known as the monthly dividend company for 26 years in a row by paying monthly payments and raising them. When prices went up, the triple net real estate contracts, in which tenants pay most of the costs, protected realty income from rising running costs. Even though worries about inflation have gone away, realty income is still a good choice because it is one of a kind in the REIT business and has a history of paying out high dividends. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.